Ticker symbol XDTE or the S&P 500 Zero DTE Cover Call Strategy ETF, the weekly paying ETF that's brought to us by Roundhill, has recently fell into some deeper trouble due to the most recent market volatility. It's down around 12% as far as price return goes, or down around $6 on the max time frame. Now, this ETF has been pretty popular across the income-oriented community, and this is because it offers a unique strategy that harnesses volatility and offers you exposure to the S&P 500. Now, along with it, this ETF offers a 22% distribution rate. And did I mention that it pays distributions weekly? Now, in this video, we're going to go through some of the trouble that this ETF has recently fell into and why this ETF might never recover to its NAV. So if you're a dividend income focused investor, and especially if you own some shares of XDTE or have ever thought about it, make sure to stick around, drop a link down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. Now, just to go over some of the basics for those of you guys that aren't super aware about this ETF or don't understand how it works. It says XDTE utilizes a synthetic cover call strategy that seeks to provide current income on a weekly basis, while also providing exposure to the price return of the S&P. The overview says the Roundhill S&P 500 Zero DTE Cover Call Strategy ETF, or XDTE, first ETF to utilize 0 days to expiry or Zero DTE options on the S&P 500, and that this ETF provides overnight exposure to it. By doing that, it generates income each morning by selling out of the money Zero DTE calls on the index, and this ETF is of course actively managed. Now then it says why XDTE weekly distributions. This ETF seeks to pay out distributions weekly out of sold option premiums. Income potential. This ETF seeks to generate income through a cover call strategy on the S&P. And lastly, it says harness volatility. XDTE sells Zero DTE options on the S&P and seeks to exploit structural market mispricings. Now, looking at some of the distribution history so far from XDTE, and again, these are payouts on a weekly basis, which is very rare because most ETFs across the market pay out every single quarter or maybe month, but this ETF pays out weekly. So the most recent payouts, 14 cents, 20 cents, 22 cents, 23 cents. I mean, if we were to even look at those last 4 payouts, that's a massive amount of income in a single month. Then before that, there were certain months that were much higher in the 64-cent range, and then everything else in between. Now, like I said, as of right now, this ETF is offering a 21% distribution rate. So even with some decay in price, investors are still hoping to make up for it with, of course, that massive amount of income. Now, all that brings us into an article written by Kevin Sean on seekingalpha.com. It says XDTE, this fund will never recover its NAV. It says the Roundhill S&P 500 Zero DTE Cover Call Strategy ETF that offers 20+% yields and weekly payouts, but investors need to be mindful about NAV erosion and potential tax implications. This article got my attention, so I knew I had to make a video about it and share it with you guys. It says XDTE's synthetic cover call strategy is subject to mark-to-market rules that prevent XDTE from recovering its NAV over the long run. These rules also subject XDTE to potential unintended tax consequences that investors need to be aware of and plan around. Overall, the positive return totals and large payouts give investors more control over their finances that could be worth more depending on their personal situation. I rate XDTE a buy so long as it maintains total return closely correlated to the S&P 500 and its AUM. They then said with the S&P 500's increased volatility due to various factors such as China's AI developments and Trump's economic policies, cover call funds are anticipated to generate large premiums from their option strategies. These increased distributions, along with the fall in the price of the fund, may make cover call funds an attractive buy right now for the potential to secure high yield on cost. One such fund is the Roundhill S&P 500 XDTE, which yields 26% at its current price and is a great addition to many income investors' portfolios. But before buying, investors need to understand the mechanics behind these large distributions. Roundhill's fund is unable to recover its NAV over the long term due to the mark-to-market rules on Section 1256 contracts. That said, NAV erosion is a small issue, so as long as XDTE meets the requirements of sustaining its AUM and maintaining positive long-term total returns. The more significant problem is that XDTE investors could face unintended tax consequences that could reduce returns significantly. These tax consequences can be avoided by holding this in a tax-sheltered account, and also could be a hit worth taking depending on how much an individual places on weekly distributions and cash flow. They then said XDTE faces permanent NAV erosion. Let's read on. As suggested, the fund names XDTE is an ETF that sells 0 days to expiry or 0 DTE call options on the S&P 500 with the goal of generating income on a weekly basis. Key things to note is that XDTE runs a synthetic covered call strategy that trades index options that are classified as 1256 contracts. These options have multiple benefits, like cash settlement and European-style exercise, where contracts cannot be exercised until expiration dates. It then said due to the classification of SPX index options as 1256 contracts, XDTE faces the mark-to-market rule as a regulated investment company or RIC, must distribute their gains or otherwise face tax consequences within the ETF. The result of that is XDTE will never recover its NAV because its long-term gains in the underlying are always realized and distributed by the end of each year. This is why XDTE had an enormously large distributions at the end of last year. Now over time, XDTE will offer smaller and smaller distributions and will likely reverse split as NAV per share falls. Now how is an investor supposed to mitigate NAV erosion? Listen in. Despite these NAV erosion issues, I am still bullish on this ETF as an income investment. He then said although XDTE has only been around for a year, its performance allows us to reasonably expect that it will continue to track the S&P 500 with a minimal upside loss. Selling covered calls as a strategy is one of the sacrifices because you potentially give up some of your upside. In return for income, of course, as your gains are capped by the strike price you set. What XDTE has demonstrated in the past year, though, is that the management team has managed to capture the majority of the S&P's upside, and sometimes more, even after that 0.95% management fee, but at the cost of less downside protection. Now lastly, they said XDTE is a buy under the right circumstances. For many investors, taxes can generally be avoided by investing XDTE in something like a tax-sheltered account. Depending on your personal situation, these tax consequences can also be minimal relative to the value that it provides with these distributions. Now as I film in this video, the total return for XDTE, this is all the income and the price decay now included, is still up around 11% or so. But this is much different than just a few weeks back when this ETF was up over 20% total return, which now has almost been cut in half. Now I personally always look at ETFs like this one, these more income focused ETFs that do yield, let's say, north of 20% as ultra high yielders and a little bit more risky than other ETFs in the market. Now for that reason, I would only personally add a small portion of this ETF to my portfolio and use it as more of a gamble lotto play, and honestly just kind of have some fun with it and earn weekly income. Now all that to say that the NAV erosion for all these ultra high yielders is still something that definitely needs to be addressed and can only be mitigated by either averaging down, buying more and more shares to lower your cost basis on red days, which again can sort of be like catching a falling knife, or just hope and pray that the distribution stays steady and if not go up over time, making your total return for these ultra high yielders definitely worth it. So now that we talked about XDTE, the S&P 500 0 DTE covered call strategy ETF, and I shared with you guys some potential warnings of this ETF, I want to hear from you guys down below. Would you personally feel comfortable adding shares of XDTE to your portfolio? Let me know yes or no in the comments down below. If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.